MACD indicators are indicators built in stock softwares. Most built-in free indicators are not good. But MACD is one of the few classic indicators. MACD is an indicator designed by Gerald Appel in 1979. The full name is Moving Average Convergence and Divergence. There are two lines in MACD indicators. Orange line is DIF, called fast line. The blue line is DEA, called slow line. Above the zero axis is a positive number and below is a negative number. In addition, there are red pillars and green pillars. Number 1. Assess whether a stock is bull or bear. If both lines are above the zero axis, it means that the stock is bullish. If both lines are below the zero axis, it means that the stock is bearish. Number 2. Use the golden cross to judge the time to buy. Use the death cross to judge the time to sell. If the yellow line crosses the blue line upwards, it will be the golden cross. He thought it was buying time. On the contrary, if the yellow line crosses the blue line downwards, it will be the death cross. He thought it was a selling time. Number 3. Use MACD to judge the trading opportunity. MACD are very much like pillars. If the pillar turns from red to green, it means that the trend has become stronger, which is considered by him as buying points. On the contrary, if it turns from green to red, it means that the trend becomes weaker, which is considered by him as a selling point. MA is the moving average of the close price of stocks in a certain period. For example, the algorithm of MA5 is, sum the closing price of the stock for nearly 5 days and divide by 5. Then do the same arithmetic average every day. Connecting these values into a line is the 5-day moving average. MA is insensitive to the latest changes in stock prices and has the serious lag. EMA indicators make up for the shortcomings of MA. EMA is more sensitive to prices and can better reflect the latest changes in prices. For EMA, the more recent the close price is, the more important it is, and the greater its weight is. The number used for short period EMA is 12 days. The number of long-term EMA is 26 days. The distance is subtract EMA 26 from EMA 12. Connect the distance into a line and draw the orange line DIF. DIF is the distance between short period EMA and long period EMA. EMA is the exponential moving average. The shorter the period of EMA, the more sensitive it is to the change of stock price. EMA 12 responds faster to prices than EMA 26. In order to let users to see the distance between DIF and DEA, multiply the distance by 2, which is MACD. Draw the pillar in red or green. In conclusion, the core of MACD indicator is EMA. It studies the convergence and divergence between EMA 12 and EMA 26. To make judgments on the timing of buying or selling. The shortcomings of MACD. 1. Lagging. 2. It is difficult to use in a bear market. 3. It is difficult to use in box. 4. In the bull market, even if there is a death cross, it doesn't mean to sell. 5. In the bear market, even if there is a golden cross, it does not mean buying. If Gerald Appel knew how to invent MACD, he also knew why. He had the ability to upgrade MACD. He would not publish the upgraded indicators. Remember, he invented MACD in 1979. We should all pay tribute to him. MACD is one of the classic indicators which built in the software. Nowadays, more and more new indicators. Some indicators are more accurate than MACD. The role of MACD is no longer to judge selling and buying. But its divergence, combined with other indicators, improve the credibility and success rate of buying and selling. To become a high-level expert, you need to know not only learn wave theory, draw lines, indicators, fundamental analysis, position sizing strategy, but also watch out the world political things. The impact of such as Russia's invasion on the stock market is uncontrollable. If you join the membership, you can see how to use the divergence to improve the success rate and reliability.